When stocks are plummeting, you rarely know what will happen next, and that can be terrifying. Is the drop just a short market correction or the start of a lasting downturn? This uncertainty can be extremely uncomfortable, but selling out of stocks at the first sign of choppy waters can be costly if you're wrong and stocks rebound quickly. That's why it's important to have a disciplined process for evaluating whether what you're seeing is a bear market. There are many theories for what causes bear markets, but unfortunately many are misguided. Keep in mind, bear markets are a complex and emotional topic that deserve to be examined from multiple angles. For more information on how to identify a bear market, please see our Bear Market Indicators video. And if you'd like more information on how to navigate bear markets, you can watch our 4 Bear Market Rules video. In this video, we'll explore some common misconceptions about identifying bear markets. Bear markets are fundamentally driven stock market drops of approximately 20% or more over an extended period of time. Many confuse bear markets with bull market corrections. However, corrections are short, sharp, sentiment-driven drops of roughly 10 to 20%. Importantly, corrections are often based on fears that appear plausible but don't actually threaten the global market or economy. Because corrections are driven primarily by sentiment, which can turn on a dime, trying to time corrections is futile. On the other hand, bear markets have fundamental causes with the size and scale to disrupt global markets. With extensive research and discipline, we believe it is possible to identify a bear market as it is unfolding, sidestep a part of the bear, and mitigate some losses. But many investors often focus on the wrong data points or false indicators, making it difficult for them to correctly identify a true bear market. Many investors assume bear markets begin with steep and sudden market drops. But history shows bear markets usually begin with a slow rolling top, rather than a quick steep decline. As shown here by the 73-74 bear market, about 1/3 of the stock market's decline occurs in the first 2/3 of a bear market's duration. And about 2/3 of the decline usually occurs in the final 1/3 of the bear market's duration. This slow start to bear markets means that you usually have some time to make sure you're really experiencing a bear market before making changes to your investments. Though many may use the terms interchangeably, bear markets and recessions are different. A bear market describes the state of the stock market, whereas a recession is a broad economic downturn typically defined as a decline in gross domestic product, GDP, for 2 or more consecutive quarters. Bear markets often start before recessions, and while sometimes the two overlap, they are separate and distinct. Like most economic data, GDP is backward-looking. It summarizes how an economy performed in a previous period. However, stocks are forward-looking, and normally by the time GDP data has been released, stocks have already priced in poor economic conditions. Rarely do recessions and bear markets start simultaneously. Here you can see that in bear markets accompanied by a recession, the market has peaked before the recession began, except in 1929 when the economy peaked first. The lag between the two peaks can be months or even a year or more. Additionally, in the US, multiple bear markets have occurred without recessions. Here you can see that the 1961, 66, and 87 bear markets were recession-less. In our view, waiting for a recession announcement is not a reliable way to identify bear markets. Many investors use employment data when trying to identify bear markets, but employment data is a late lagging indicator. It provides evidence of what has already happened in the economy, not necessarily what will happen next. During a bear market, stocks often begin falling long before companies start laying off employees. Here you can see that employment numbers, as measured by non-farm payrolls, often peak after a bear market has already begun and don't rebound until after the bear market has ended. Using employment data to try to sidestep a bear market could be costly, as you may end up getting out of stocks after experiencing significant losses and buying back in after stocks have already rebounded. Regardless of how much research you've done or how sure you are that this time it's the big one, going defensive and selling out of stocks is risky. If you're invested in stocks, it's likely because you require some growth to meet your long-term investing goals. Once you sell out of stocks, you open yourself to the risk the market rises while you're not investing. And it can be difficult to decide when to get back into the market. Reinvesting too soon could mean incurring additional losses before the market rebounds. But that may not be as detrimental as getting back in too late. Missing the initial V-shaped recovery that typically follows bear market bottoms can be a huge cost, as the bounce can help you recoup some of the bear market losses quite quickly. Keep in mind, if you have a longer investment time horizon, you can likely still reach your goals without dodging bear markets. Bear markets are certainly a setback, but markets do recover, and so can your portfolio. For example, stock's long-term average of 10% annualized returns includes all bear markets. So you don't need to necessarily sidestep a bear market in order to realize long-term growth. Making disciplined investing decisions is challenging, especially when emotions run high. To help you create a plan and stay on track, you may benefit from working with an advisor. Contact Fisher Investments if you'd like to learn more about how we might be able to help you. If you enjoyed this video, please subscribe to our YouTube page and check out our other bear market content. Thank you for watching.